Better Business for Good TV. By small business owners, for small business owners.
Welcome to episode 11 of Better Business for Good TV. I'm Brenda Thomson. In this week's episode, I talked to Paul Nayda from GetCapital about a new finance product, Shift Payments. GetCapital is an award-winning specialist business lender dedicated to meeting the needs of Australian businesses. They've been beta testing Shift Payments for around a year now and brought it onto the market a little over a month ago. The goal of Shift Payments is to change the financing landscape for businesses who provide trade terms to their regular customers. It does this in 4 ways. First, by improving cash flow management for sellers while letting buyers choose their own trade terms, and that's a win-win. Relieving the tension between buyers and sellers. Let's face it, none of us enjoy putting on those debt collection hats and asking for money. Improving the accounts receivable process by putting it into the hands of professionals. And perhaps most importantly, in this COVID-19 environment, removing the financial risk associated with offering trade terms if one of your debtors goes into receivership. And because I'm no finance expert, I've invited some guests, including several of our Better Business for Good company financial management advisors, to help me go under the bonnet of Shift Payments. Martin Katak, Business Working Capital Strategist from Finance for Business. Janine Purdy, Credit Management and Debt Collection Specialist from Repaid and Business Credit Solutions. Dheeraj Sachdev, Bookkeeper and Financial Management Specialist from First Class Accounts Parkdale. Ian Harris, Accountant and Business Advisor from B&I Lockwood Accounting. And Greg Ferret, Renewable Energy Finance Specialist from ASM Money. And with a customer perspective, Damien Battersby from Proactive IT Solutions. We'll be back to grill Paul shortly, but first, a short message from the Better Business for Good company.
We like to describe it as an alternate way to offer trade terms to your customers. And when we talk about Shift, we'll typically talk about it as a platform where there's 2 very important but distinct audiences. One is our suppliers, who are typically supplying goods as well as supplying terms, and those people that buy from them. When we describe the platform from the supplier's point of view, we will tell you that you're going to get a platform which in principle gives you the same capabilities that you would enjoy when you're running a trade credit program internally. And so the core functionality on the platform is the ability to enroll a customer in and offer them trade terms. And then the second capability is a capability to transact on that platform. So that is that ability to take an invoice that's ready for either dispatch or delivery and bill a customer's trade account using our platform. The main advantage of using Shift as your trade credit solution is that rather than you supplying the financing for those trade terms, we as GetCapital or Shift Payments supply them for you, which in practice means that your customer still gets the terms that they enjoy today, which might be 30 days or 30 days end of month, something like that. But you will receive your money today or usually next business day. So in substance, what that means for you as a supplier or as an offerer of terms on our platform, you've made a cash sale and your customer is still getting the terms that they enjoy today.
Can you perhaps put that into a case study for us, like an example of who that might really benefit?
Yeah, sure. There's lots of different, and I've got some really interesting cases that will, when I talk a little bit around some of the problem statements we were encountering early on in the process, a bit later on. But a typical customer, best to start off with, could be, we've got a wholesale lumber yard, for example, on our books at the moment. So they might, they're buying from a Met Cash or a Mitre 10, something like that. And then they're usually supplying to local builders doing either whole spec builds or extensions, something like that. They would be typically offering, say, 30-day accounts, and their particular problem statement actually centred around not wanting to. That's a really interesting one, actually. It was they were not culturally. It was quite difficult for them to culturally to actually collect on overdue accounts. Okay, so the main reason that they wanted to use a third-party platform was that it actually took the difficult conversation off the table. And so what they were doing was enrolling all of their customers in Shift, and then they would trade just as they usually would. But when it came to making payments, that was actually a process that they handed off to us. But our typical customer would look on the supplier side, would typically look like someone in food and beverage wholesaling, something like that. So they could be a small goods distributor or a juice or liquor manufacturer, something like that. We deal with a lot of customers in trade and construction, so they might be, like I said, a timber wholesaler or supplying specialty parts. So we've got customers selling all sorts of weird and wonderful things, specialty bolts, doors, glass, that sort of thing, as well as who else? Guys in sort of that fresh food and vegetable sort of space. We've got tobacco wholesaler, for example. So you can sort of see there's quite a range of industries that we deal with.
Yes. So it's very much somebody who's supplied the services and has had to, or supplied the products and has already had to pay for them themselves potentially, and so that they're actually getting paid right away, so that they can pay for them, or the services, and so that they can actually pay their tradies, or that's the
perfect.
So it's really cutting out that horrible gap where they've forked out the money before they get the money in, because they're trying to keep their clients happy by giving them terms.
Absolutely. So it's all about managing that working capital gap. So look, just quickly, I'll just cover off the other audience that we've got with our platform. So we call them our buyers. These are customers that the supplier is selling to. And when we talk about our platform, if you're enrolling your customer into the Shift Trade Credit platform, what we're issuing to your customer is a financial instrument that largely replicates exactly what a typical trade credit account would have. So that is, you've got the ability to transact on terms up to some limit, which we'll call a credit limit. Typically, there's no charges payable by the buyer, but I'll come to some of the other features that we will talk to that I'll talk to in a second. But you trade on terms up to a limit, and there's zero charges payable by the buyer. Now, one of the important features that we like to solve for, and there are three particular use cases which we find that we're talking about the most, is that trade tension that you're talking about. So where we see it's quite powerful is that one person's accounts receivable is another person's accounts payable, and there's generally this opposing tension between the two parties. When the transaction's facilitated on our platform, what we grant is the ability for the buyer to actually choose their own terms. So the supplier might say, issue an invoice that's due and payable in 30 days' time, and then the buyer can actually come into the platform and say, actually, I want to pay that invoice in 38 days' time or 45 days' time. Now, the incremental finance charges are borne by the buyer under a transaction like that. But what in substance it's done is taken that tension out of the buyer and the supplier relationship, where we're quite happy as a financier to sit in between that transaction and make sure that as a supplier you're getting paid as quickly as you want, which is usually same day. And then the buyer, we like to think is matching their the terms that they want to pay on to their working capital cycle as well.
So if we dig into that a little bit, so as the seller, you're getting paid today. today or tomorrow, which is obviously the ideal scenario. But if you were previously saying I guess I have 7-day invoices or I have 30-day invoices or whatever your terms previously were, then the buyer can either accept those or they can even extend them further with you. Is that what you're saying?
Absolutely, that's absolutely spot on.
Which as the seller, I would not have been terribly happy to do because I'd already paid for the.
Absolutely, and you need to finance it, and you know the longer the terms, the bigger the working capital drag for you.
So can I perhaps get you to dig into the why you decided to do this?
Yeah, sure.
The motivation behind developing this?
So our pedigree at GetCapital is small business working capital loans. So that's been the business since it was incepted about 6 years ago. When you're making when you're dealing with as many businesses as we are, you tend to get a sense that the same themes come up time and time again. And we've been playing around quite a lot with what are some of those problem statements, and are we in a position to solve them in a way that perhaps industry or the finance industry hasn't solved them before. So as we sort of kept building the shift proposition out, we tended to find that the things that we were able to solve well centered around 3 core propositions. So the first one, which we thought was actually going to be the most important one, but the more we engage with industry, the less important it's become, is just around capital management. So think the typical small business has got somewhere between 10 and 30% of their assets of their business tied up in accounts receivable, depending on what industry or what vertical that they're playing. And so that represents a tremendous source of assets, but also can be potentially quite a big imposition on a business. So we saw that we could help solve that accounts receivable problem, not in the traditional way as, say, an invoice finance or debtor finance organisation might do, but by looking at it a little bit differently and saying, rather than leverage up accounts receivable, why don't we just eliminate it completely? We solve for that problem, by virtue of you get paid tomorrow and your customer still gets terms, which we've run through. The other two, which the more we speak about tend to come out more and more, is just this idea of simplification of your accounts receivable. Yeah, so perhaps the best way to start to think about it is, it's quite tempting, I guess, to think about overdue debtors and poor payers, etc., as being a function of the buyer. That is, that they're just not capable of paying, or they want to deliberately string you out. You're the lowest priority payer, etc., etc., etc. But what we find more and more is that often those accounts receivable practices are just not well defined or not well established. And so what Shift brings to a business is a way of making sure that there is a good degree of rigor applied to the payment process. That is, you load your payment, you agree your terms at the time of ordering or dispatch, and then we know that, yep, you can choose your own terms if you want, so that gives an order of flexibility. But it also means that these relatively informal invoicing, put your BSB and account details sort of process on the bottom of the invoice and pray that someone's going to remember that on the 23rd of next month I'm actually going to show up and make that EFT payment, and it's all going to clear within the 48 hours, and all the other fun stuff that goes with that. That all goes away because we arrange the deduction of the payment on the date that you've chosen. So what we're finding is that tends to come up more and more and more. We had a very interesting use case over in WA at the moment where they're taking funny when you get into some of these verticals, but the customer is a small goods distributor, and if you know anything about ordering cheese or meat, what you order is not necessarily what shows up, because the guy goes out to the call room and just picks the picks the cheese for the day, and so you might order a kilo, but then you get 1.2 kilos or something show up at your door. So the consequence of that is you actually don't know what the invoice is going to be on the day that you get paid. Oh, sorry, on the day that it gets delivered, until after that delivery's occurred. And you sort of couple that with a COD sort of process, and how's all this going to work? What ends up happening is the credit gets provided just by de facto, as in I don't know exactly how much to pay you, so I can't arrange it there and then. So 3 days later, yeah, okay, you need to pay me straight away. And so they're considering using Shift just as a way of making that process a lot simpler in substance, just to get access to a direct entry process without having to go through what is a relatively complex process to set up a direct entry system for yourself.
And you said there was a third reason?
Yeah, sure. And I think I've probably covered it off in a good level of detail, but it's just about providing that trading flexibility. So that diametric sort of your accounts receivable is my accounts payable tension, and it's quite topical at the moment. You're hearing a lot coming out of Kate Carnell and the legislative reforms that are occurring around, particularly the bigger end of town, is that because we give both parties the ability to choose their terms, that takes all that tension out of the trade credit relationship. Well, we'd like to think at least softens some of the power imbalance that occurs inside the trade credit relationship. So we come up, same thing, we tend to come up against that more and more these days. It's not necessarily about the capital release, or getting paid on time, which is often the source of the tension, or what we thought was the source of the tension, but more and more these days it tends to just to revolve around, I just need that flexibility in the way that I deal with my trading partners.
Cool. Well,
yeah, thanks, Brenda. Very interesting product you've got there, Paul. So I've got a couple of questions. How do you guys get paid? Where's the cost? So obviously, me as a supplier, do you take like a percentage out of the invoice?
Yeah, we do. So core proposition is we offer a 14-day account for everyone for free. So there's no charges on either side if you want to deal on terms 14 days or less. Beyond that, if you're a supplier and you want to issue, say, a 30-day account or a 30-day end of month account, then we charge a transaction fee as part of providing that service. If you want to extend your terms, then the incremental finance charges are borne by the buyer in that case.
So what are we sort of talking about? So say a 30-day account, what are we talking about for that?
We'll price every supplier based on a range of factors, but typically if you're talking about, say, a 30-day account, you should be expecting a transaction fee in the order of 1.5 to maybe 2.
The buyer, as far as how do they pay that invoice? Is it like a direct credit type thing that happens?
Yeah, so when you open your account, we arrange a direct debit authority. So payments are deducted automatically from your account on the various due dates of your payments.
Okay, that makes sense. And is there an upper or lower limit on the invoice value?
Facilities aren't secured, so we do have policies around what the maximum limit is that you will get. So typically, if we're talking more than about $250,000 in limit, then we may impose some additional collateralization requirements. Below that, then buyers and suppliers are free to transact within the limits that we've allocated.
Essentially, what I wanted to know was how new is this product and how many other players are there in this kind of a product market?
We've been running a pilot program for a little under 12 months now. During that time, we processed around about 10,000 odd transactions before we made a broader decision to take it to market, which we did about 4 or 5 weeks ago now. In terms of who our competitors would be, I don't think I could point to someone directly in the market that's doing exactly what we're doing. But suffice to say, there are other solutions out there in market that may solve one or more of the problem statements that I outlined earlier. Things like debtor finance or invoice factoring.
And you did mention to Damien that at a 14-day level, it's a no-cost thing. Did I get that right?
So if you are a supplier and you want to issue a 14-day account, you will get paid tomorrow and your buyer will need to pay us in 14 days' time. we do find that a number of our buyers do want to extend the due date of their invoices. So even if a supplier is only issuing on 14-day terms, a number of them will want to take those invoice due dates out to 21 or 30 days. And we do charge a transaction fee for extending that due date.
And that's then the buyer's choice. So the buyer's accepting it's kind of like accepting the credit card fee on when you want to pay by credit card.
Perfect example.
Right.
What about the customers themselves? Do you vet them in some shape or form?
There's a vetting process where we go and assign a trading limit and a maximum set of trading terms available to that customer. That process looks and feels relatively similar to a process that a supplier may go to open a trade account, or a lender may go to underwrite a loan.
Well, I guess over the years, and you mentioned it before, the whole AR process, and do you know, you must have heard this, you'd get this all the time.
The treatment of buyers or debtors is perhaps leaves a little bit to be desired. Is that for diplomatic? Yeah, we think it's an area that's relatively ripe for some different thinking, but we also understand that the people that will be faced with the most change from using Shift in their business are probably people that may, take some coaxing from the business owners in order to actually facilitate that change. So what we would say, and what we do every time we're presented with a new supplier who's interested in using the platform, is we would encourage people to, the Shift is not something that you just need to lift up your entire business and plop the entire thing on, you just revolutionise your AR overnight. It's something that you can use either as a tool to sit alongside your business. So for example, if you've got peak trading periods, so pick floristry or wholesale flowers or fish or something like that, there are plenty of places where sales just boom for 2 weeks or 2 days of the year and then fall off. So what we work through is identifying some of those bigger pain points, and then we'll come and have a discussion about what might be the best approach to solve that business problem, but in the context of, we do need to intermediate or at least support the intermediation of a buyer and a supplier relationship, which might take some effort on both parts.
Who decides which clients of mine are going to I'm going to put it onto the program and which ones are not? Is there a credit check on all of my? If I took my whole AR and outsourced them to GetCapital, would you then go and do a credit check on all of my clients?
It's completely up to you who you want to enrol and who you want to continue to deal with on your own balance sheet, and even more, you're under no obligation to put, for example, all of your payments through our platform at all. In terms of when we conduct our searches, at the time you enrol your customers, so you go into our portal and you've got your list of customers there, and you can add another customer at any time. We receive a request to open a new account, and that's the time that we would underwrite the customer. So in that case, conducting bureau checks, etc., would occur at that time.
Paul, as you got into that relationship, presumably you would identify risky debtors faster than we would be able to. What happens then in the management of that as you identify a risky debtor that we still want to have a relationship with?
So you're welcome, just like you're welcome to use Uber Eats or go directly to the restaurant, you're more than welcome to trade on or off our platform at any point in time. And then perhaps better explained by the experience that you may have is when we set up a customer, we're going to assign them a trading limit, the most that can be outstanding from them at any point in time. And that limit is, dynamic's not the right word, but that limit may be reduced as a result of, for example, them not paying their account on time, just to give a scenario that we're all familiar with. And so in that case, what you may find is that the limit is not sufficient to be able to continue to deal at the order of magnitude that you've been dealing with them in the past, albeit in practice it's very much a rarity unless a customer is significantly overdue with us. And so in that case, if you still want to deal with them, obviously you can deal with them off the platform.
I tell many clients that particularly in this COVID environment, it is the absolute best time to reset your trading terms and trading arrangements. But I wanted to clarify, because one of the most important things I see that the product offers is it transfers risk. If I am the supplier and hold my own trade credit, I take the risk of that transaction. And by that, I mean the financial risk that the company becomes insolvent. I don't have trade credit insurance. And I've had clients turn around to me and said, look, I've just lost my second major client. It's cost me 50K and I don't see how I'm going to come out of this. This, to my understanding, I just want to clarify, basically what you're doing is transferring the risk to a lending institution that understands and manages that risk. So I could say to a client, if you move to shift payments, and I agree it would be a toe in the water thing at first, but you can eliminate your credit risk from your business.
You've got it spot on, Martin. Maybe just walk that back through the practical example again. So I'm offering a 14-day account to my buyer. You post a transaction as a supplier to my buyer's shift account today. We pay you tomorrow, and the credit risk associated with your buyer paying now sits with us at Shift Payments, not with you at Supply Co XYZ.
To me, in a post-COVID environment, managing that risk, because part of the problem is often the suppliers don't have the expertise in accounts receivables to really manage that risk properly, and you do.
That's 100% right. So COVID has definitely, I think, given a few people a few surprises. I think there's plenty of media coverage about what's happening in the lending industry, but certainly our experience in the supply chain as well there's been a lot of people that have been forced to shut down and had to go back up to their suppliers and say, look, I've been forced to shut. I can't actually pay you for another 6 or 8 weeks, which that might have been the first time that many suppliers have actually, really felt that they are actually, lending or certainly taking credit risk against their customers.
And that's a wrap for Better Business for Good TV for this week. Thanks to the Better Business for Good advisor team who helped us get under the bonnet of Shift Payments to understand how it works, who it's for, and how a business might best take advantage of it. If you want to know more about how Shift Payments might be able to help your business, then have a chat to Martin Katak from Finance for Business. You'll find Martin's contact details right underneath this video. Before I sign off, a reminder to grab your copy of 21 Things That Highly Profitable Businesses Do That Less Profitable Businesses Don't Do. It's a summary of the results we found when we were developing the Better Business for Good business improvement planning tool, the BIPlan system. If you want to know what you need to do to make your business more profitable, then you need to read this report. You can download it at BB4G TV. And of course, you can get a free demo of the BIPlan system itself to see how it might help your business at bb4g.co. Now to close, here's this week's 1-minute Business for Good idea from Carolyn Butler-Madden at The Cause Effect. And we'll see you next week.
Carolyn Butler-Madden here, Chief Purpose Activist at The Cause Effect, coming to you with another Business for Good example. So in 2020, Australian music has fallen on hard times, and American Express has stepped in to support the industry. So they're inviting Australians to keep singing, keep buying records, keep streaming, keep sharing songs, keep buying tickets, keep the music playing. The $1 million American Express Music Backers Fund is here to help Aussie fans, artists and music businesses on the road to recovery through grants, competitions and more. A couple of ways they're doing this. They're inviting people to nominate a mate that's doing good for Aussie music and win $1,500, plus grants for Aussie artists and music businesses of up to $50,000. So my question is, what organisations or sector could you give a helping hand to that's doing it tough because of COVID?
Better Business for Good TV. By small business owners, for small business owners.